One of the things I've long argued about DraftKings is that the company's profitability or any potential profitability is not really sustainable long term. And that's in part because it's going to get competed away by competitors. It's just a click away to go make your bet at another app. And also that the customer acquisition costs are just going to continue going up as the industry grows. Now, there has been some progress on that front. Management said that customer acquisition costs did come down, and that is a positive sign for DraftKings. But the other thing, and this has come up over the last 6 months or so, is that any profits that are being generated by companies like DraftKings who don't really have a physical presence in a lot of the areas that they operate, there's no incentive for a legislature or a governing body to allow those profits to just be siphoned off into another area. So we have started to see higher taxes on online gambling because there's no real benefit for a state not to do that. And this is going to be a fundamental challenge for DraftKings going forward. One of the reasons that the physical gaming industry has always had kind of a symbiotic relationship with the states where they operate is they provide jobs, they provide tax revenue, they provide a draw for travelers. So tourism increases because they have gambling. It is attractive for a lot of states to have gambling and resorts and casinos in their locations. Online gaming doesn't really provide the same benefit. And we saw that in the most recent results. So I want to dig through those today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's go to the presentation to give an idea what DraftKings saw in the quarter. So here's a few of the highlights from the second quarter. Revenue was $1.1 billion, 26% growth year over year, $128 million in adjusted EBITDA. That's going to be a proxy for cash flow coming from the business. They are increasing their fiscal 2024 revenue guidance to $2.05 to $2.25 billion. Here's a breakdown of the reason for that increase. This is the guidance given in May. You can see that that was increased by about $250 million. The biggest impact was stronger customer acquisition, retention, and engagement. Adjusted EBITDA is also supposed to be a little bit lower than expected. So there's a tax rate increase in Illinois, unfavorable sports outcomes, an impact from Washington, D.C., and those customers are now not as profitable. So good, revenue is growing. Bad, adjusted EBITDA is going to be lower than expected. The other big thing, and this got a lot of attention from investors, is they are implementing a gaming tax surcharge in certain high tax states beginning the 1st of 2025. So this is to be a little bit more operationally effective, but this is going to go into effect in Illinois, New York, Pennsylvania, and Vermont. You can see what this would look like on the right. You wager $10, you win $20. Instead of getting that $20, you're going to pay a tax of 32 cents in this case. So it's going to basically reduce your winnings. That will also show up right down here when you place a bet in the app. So this is going to have a pretty big impact potentially on the bottom line and customers' interaction with the business. One of the things that was interesting was they kept their adjusted EBITDA expectations for fiscal 2025 flat. And there was a couple of reasons for that. The Illinois tax increase is going to be a headwind. And then they're expecting benefits from Jackpot and launching OSB in Washington, D.C. And then those stronger customer acquisition, retention, and engagement that I talked about earlier. So add all of those things together and you get flat guidance for 2025. Now, there are some positives. There are a ton of new customers coming to the platform. You can see this really started during the pandemic, 2020. That was when we started to see more jurisdictions open up to online gaming. You also had customers just become more interested in it. So that took a big jump to 8.4 million unique customers in the prior 12 months in the last quarter. Gaming market share was also pretty flat. The other thing that I want to call out here, this is a breakdown of their net income to adjusted EBITDA, but they do break out. The run rate is nearly $400 million per year in stock-based compensation. That is a massive number for a company with the market cap of under $16 billion. So just wanted to highlight that. That goes into expenses, and it's obviously a non-cash expense, but would love to see that come down from an investor perspective. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. In a lot of ways, the quarter was a step in the right direction. And this is something that DraftKings has been doing for a couple of years now, where their customer acquisition costs are coming down. They're getting a little bit more value out of those customers. pushing to things like more parlays, which are much better for the house. Operating costs is being spread across more and more revenue. And so those are the trends that you really want to see. And this chart really shows how quickly operations have improved. On the left, the dark orange column is total revenue. These are trailing 12-month numbers since 2021. So you can see that that's grown at a phenomenal growth rate of 62% on a compound basis. Cash from operations was obviously negative in 2022, even through 2023. That has turned positive over the past year. And even free cash flow is slightly positive over the past year, $159.8 million in positive free cash flow. But this is where you get to the challenge, and this is why the tax and the increased tax rates are becoming, I think, so important to DraftKings and the future of the industry. Because, like I said, if this company does become significantly profitable, what incentive is there for jurisdictions in the states that people are gambling in not to just increase taxes and eat away at the profit that the company is making? Now, they can try to pass those costs onto customers, but that's going to mean that the odds of each bet is going to get worse. That's not going to be an attractive draw to customers. And so this is a fundamental problem that I think these online gaming companies are going to run into. This is why I don't think there's a whole lot of value in the online gaming business alone. I think it needs to be paired with something with physical gaming. This is why I own shares of MGM Resorts. Now, they don't have a ton of value in their BetMGM business, and they have struggled to make that business profitable, but there is at least a tie between the physical business and the physical casinos that they have and the online gaming that they have. So they can lower their customer acquisition costs. They can give incentives to bring customers into the physical casinos. There's a real tie there, and there's a reason in a lot of those states not to overtax that online gaming. With a company like DraftKings that's just online, you don't have the same benefit. You don't have the same incentives. And I think this is something that's going to come up over and over again, whether it's customer acquisition costs going up, long-term value going down as people leave platforms because the betting odds get worse, or maybe they just get sick of losing money. Or if everything does continue to go well from an operational perspective, states and jurisdictions come in and say, hey, we want to increase the tax revenue. You're making a lot of money. We want a little bit of that because you're taking it out of our customers' pockets and taking it to a different state or different investors. So this is the fundamental challenge, and DraftKings really showed that in the most recent quarter. This is why this is just a stock that I stay away from. I don't see the long-term value in how this company becomes sustainably profitable. I know that it's easy to talk about this like a SaaS company where you spend a certain amount of money to get customers. You have a lifetime value of those customers, but I just don't believe the long-term value of each of those customers because something is going to eat it away. Right now, it looks like one of those things is going to be taxes. But what do you think of DraftKings results? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.